Let's shift over to industrial and hit the industrial market and what's going on in the industrial space. We love industrial. Can be more difficult to acquire, but we only from perspective. There's not a lot of stuff available. But let's dive into industrial.
We like industrial. Deal sizes tend to be smaller. We work hard to acquire it. I think it's really important to keep in mind the types of industrial. We're really going to bifurcate this presentation into two types of industrial. You have the very large 500,000 million square foot distribution buildings that over the past few years have seen similar supply imbalances as what multifamily seen. Not to the same level or magnitude, but there's been quite a bit of development focused there. Our bias, our viewpoint is to flex industrial, shallow bay industrial. You can almost equate it to multifamily for industrial. It's product type that was typically built the last 2+ decades ago because rents do not justify development costs today. And because that, we're very compelled to acquire these assets well below replacement cost, often with a strategy to grow operating income and feel like those are some exciting investments to make. Certainly more operator intensive. That's work we are happy to take on. We believe we can manage those well and grow value. So to restate supply, we've seen some significant increases in supply over the last few years, in large part driven by low interest rates and cap rates going back 21, 22, 23, et cetera. And the risk with industrial is supply can go up more quickly.
And you're really talking about the high bay distribution space. It's not the flex space, which is the that's already cut up in smaller bays.
Exactly. The data that we're going to present is in very large part skewed by that. And the institutional capital that wants an Amazon net lease industrial building is willing to pay a premium that we aren't going to pay for that property, good tenant. But it's a fundamentally different investment strategy that does, I would say, skew some of the data that we're going to present. Exactly to your point, Tim, the flex and shallow bay product hasn't been built. I would say from the demand side, the current administration's goals are pretty clear. We've seen tariffs. We've seen certainly other efforts to reprioritize manufacturing jobs coming back to America. That will be healthy as it relates to future demand for industrial, both the large distribution product where we are not as active and the more shallow bay flex industrial.
Yeah, it's the small businessman that lands in the shallow bay product.
Exactly.
Right? And the more jobs that come back here to the States, the more demand there is for that space. So what about some of the overall metrics of rent growth, occupancies?
Yeah.
What are you seeing?
So like we described in multifamily, supply and demand, and the intersection is price. We have the exact same chart presented here in industrial. And what you'll note, if you look at the last 4 to 5 years, the directions move the exact same as the multifamily space. You see great demand, nice rent growth in the early 2020s, followed with an increase in vacancy and declining rent growth as we approach the mid-2020s. The reason for that, the same low interest rates and cap rates that applied to the multifamily sector in 21 through 23 really applied on the industrial side as well. Didn't see the level of oversupply that multifamily saw. And because of that, you're still seeing real rent growth in the industrial space, even positive rent growth, but certainly very similar economic activity the last 5 years and trends is what we saw in the multifamily space.
I know they built a lot of industrial stuff all over the country. There's been some pretty big numbers. You want to share some of that math?
Yeah. Great to consider the new development in the context of net absorption. What we present is if you look back almost over 15 years worth of data, over the last 15 years, net absorption, so demand in excess of what's built, has totaled about 170 million square feet of industrial, roughly 12 million square feet per year. Pretty compelling long-term trend as it relates to the growing demand for industrial space, because certainly we noted some increase in supply. We noted demand as it related to the current administration and their goals and why that supports more industrial demand. The growth in e-commerce and the expected continued growth of e-commerce is certainly a trend that we expect will result in more industrial demand in the future as well.
And is there any kind of uh, uh, changes with the higher interest rates now and costs being up? Are you seeing any impact? What's the impact been to the marketplace's new supply creation?
So over the last 2 years, we've seen a meaningful decline in net deliveries and fully expect that is because the elevated interest rates, the declining rent growth, and the elevated vacancy. Developers have seen that the new buildings developed on spec, so without a tenant's lease ready to occupy the space, they're taking longer to lease up. The demand for that space isn't as robust as it was in the early 2020s. And we've seen a meaningful decline in the new starts.
So it probably has an impact on occupancies as well.
Yes, absolutely. And going forward, if thinking about the demand drivers, e-commerce, bringing jobs back, manufacturing back, that combined with declining starts should result in some healthy rent growth and vacancy in the future as well. So as an asset class in its entirety, we're bullish. We're especially bullish in the space that is least developed, which is the small suite industrial, very heavy multi-tenant type industrial. We have sizable portfolio across numerous markets, primarily in the Midwest. So markets throughout Ohio, Indiana, Illinois, Minnesota, Wisconsin. And that's been a high performing sector for us. It tends to have very little in the form of tenant improvement costs, which is why we like this. Industrial is an asset class with low capital expenditure costs and a pretty sticky tenant base. And nominally, when you have some small suites, you try to grow rents, maybe 4 to 6%, some rent growth in excess of inflation, the monthly increase to these businesses can often be as low as hundreds of dollars, sometimes maybe thousands of dollars. And nominally, it's pretty easy for the tenants to take that on, to continue to operate their business. And I think it's helpful to get a sense of who those tenants might be. Think of every HVAC contractor, electrical company. Think of the companies that moved out of their garage and they're servicing businesses, homes, et cetera, on a daily basis. These companies need a place to office out of, to park their trucks, et cetera. We can deliver that with the flex industrial we own, and that's an asset class we're eager to acquire more of.
Yeah, and the definition, really of the shallow bay flex space is, that multi-tenant, 1,000 to 10,000 square foot tenant. So, right, when we're talking about a 500,000 or million square foot large distribution building, this is the opposite side of the spectrum, right? This is the multifamily type of industrial, right? Very chopped up, small suites, and inherently, we kind of talk about the cost, right? What's happened with costs and development, right? All of the development was in big box, right? Warehouse or distribution, very small percentage of build out, right? You think office percentage sometimes in the, 2 to 10% range. Here in our space, it's usually in kind of the 20 to 40% office finish, right? So think you walk into a showroom or your trade, right? Your HVAC or your plumber or a showroom.
Title company.
Yeah. And they have
Flannels.
an office at the front, and then they have warehouse or distribution in the back. And every time that you add a demising wall, right, between tenants, you add bathrooms, you add more electrical, et cetera, that costs money to build out, right? So when we think about the cost to build a large distribution building, you tip up some walls, put a roof on it. There's not much build out costs, $100 a foot ish, depending on your market. To build out a shallow bay or flex product, sometimes double that, right? So the rents you need to build this flex or shallow bay product, very challenging, and you need very large rents, well below where rents are in that space to build new.
Yeah, so then the ability to move rents is real because there's no new alternative that's out there.
Correct. Yeah, and we, if you look at occupancies within that flex shallow bay product, we've just seen that of all industrial types, that has the tightest occupancy percentages, and we've seen the most rent growth in that space.
All right. So we hit multifamily, we hit industrial. Let's dive into retail. Dan, why don't you share how you're seeing the retail market right now?
The retail, when you think back 10, 15 years, back then, this was a tough space to invest in. With the growth of e-commerce and the concern of what that was going to do to retail, there were some concerns, with the health of, malls, and that's still a challenge. But back to supply and demand, when we talk about what we've seen in the retail world, there's just been no supply built, right? Year over year, a lot of the retail that has been torn down, that was bad retail and wasn't being used, or so you've had retail go away, you've had malls be redeveloped, but you've just hadn't seen any new supply. And I think what a lot of people don't realize still is that 80 to 85% of all retail sales still go through brick and mortar. 80 to 85%. I think a lot of people think 50% of all retail sales are, through the internet. And, it might feel like that at my household sometimes with Amazon boxes and FedEx boxes, but brick and mortar is very needed. And that percentage, right, when you think back to 2000, really kind of the advent of e-commerce, right? It was 1%. So you've seen growth in e-commerce, undoubtedly, but that's still only 16, 17% today.
Yeah.
And we think, a lot of the reports out there state that, they think e-commerce kind of gets to that, 25% range kind of projection. So,
many times is that there's a relationship where the retail store might even be like the warehouse for a retailer, where that's where they have the product, and they're still selling stuff online, but it's being shipped from that store from Wisconsin to California or something like that. And so the retail model's changed. And again, the lack of new construction is created a very healthy, actually, real estate environment for a lot of retail in the right locations. Overall. And people forget that we talk about population growth on the single family side. All that population growth creates more demand for more products, right? If you have 50 basis points of population growth, that means there's 50% more demand for products over a long period of time. And so demand continues to grow for retail, but yet no new space or limited new space has been built.
Yeah. And I think, our kind of view on retail historically has kind of been to, find a problem, fix it, and sell it in a shorter period of time. And that's due to, the cost of re-tenanting space is really expensive, right? You have somebody move out, you have to give them a tenant improvement allowance or TI, and that can be really expensive and detrimental to cash flow. So we've always sought to find vacancy, right? Fill it up, lease it up, and sell it. Reality is today, it's really hard to find. It's hard to find vacancy. It's hard to find that value add asset. The value add today is the ability to drive income or rents because occupancies now are so tight, right? So that intersection of supply and demand that we've talked about, retail has really kind of become a cash flow darling to some extent in private real estate. And there's a lot of folks who are now, very focused on buying more stabilized kind of, retail. So we're definitely looking in that space. And I would say our business strategy around it has shifted a little bit. But we're definitely, focusing and looking at it due to the supply demand fundamentals.
Yeah. We've had a hard time buying it because the math that people pay doesn't always work for us. And, but we're going to continue to look at it because it's got some good, the demand supply metrics that we like. Billy, you want to?
And I'll expand on that briefly. I think the math often doesn't work for us because we assume too much in the way of capital expenditures to replace tenants. So while rent growth is really healthy, while vacancy is very healthy, you don't know the cost to achieve that. And the costs on the construction side have increased significantly over the past few years.
We're pretty conservative on the underwriting. Are people going to move out or not? Yeah, it's binary. Do they move out or do they stay?
Right.
And what are you going to assume? and individual tenants. You want to dive into some of the market metrics?
Absolutely. And what you can see here as it relates to price, so rent growth and vacancy, again, the intersection of supply and demand, it's actually a quite different picture than what we saw in multifamily and industrial. And again, really focusing in on the last 5 years. If you look at the dark blue line on the bottom, you will see over the last 5 years, vacancy was pretty consistently just 4% and hovering between 4 and 5%. So retail, while there are so many fears about Amazon replacing all retailers, that is certainly not the case. Very healthy from an occupancy perspective. And if you look at the rent growth, you will really consistently see between 2 and 4% rent growth the last 5 years as it relates to all retail, demonstrating that it is really healthy from a supply and demand perspective. And that's in large part because the supply numbers are so small. So let's pivot from there to demand. And this is an interesting chart that captures the growth of sales. And I think the blue line is very telling. That is the sales growth as a percentage, and the light blue line that you can see throughout this chart. And again, focusing on the last 4 years, clearly there's quite a bit of noise in this, in and around COVID, where you saw a significant reduction in in-store retail, followed by really nice correction in 2021. But consistent brick and mortar sales growth in the, call it 2 to 5% range over the last 4 years, and long-term trends being positive, very positive as well. So to Tim's point about population growth and household formation growth, that creates more demand for more retail products. And with less supply, we're seeing healthy growth levels in all brick and mortar retail.
So overall, retail, what's happened in the marketplace, Billy?
Retail's been healthy. We've hit that, and it's in large part due to deliveries being down. This chart here, if you see that light blue line, since going all the way back to 2011, you can see net delivered square feet, less than 20 million square feet of retail being delivered across the country annually. Very, very low in the way of deliveries of retail, and the net absorption having exceeded that during that time period has resulted in the healthy occupancy and rent growth we've discussed.
Let's talk about a little bit the consumer and what's happening with the consumer and how that impacts retail.
Yeah, a couple points that we're watching closely is that, the consumer confidence or consumer sentiment has really dipped and has dropped to, actually, historic lows. We haven't seen this level. It dropped below 50 for the first time last quarter. And, what's really driving that, when you look at the top 10% of households, they are 50% of the retail spend, right? The top 20% of households are about 65% of total retail spend, right? So 20% of households out there, 65% of total retail spending. The bottom 60% of households are only 25% of total retail spending. So it really goes in conjunction with the consumer sentiment, right? We're talking about, the idea of a K-shaped economy, or right, higher income households versus lower income households. They're having a harder time at the lower end, right? Making ends meet, whether it's rent or retail spending. And it's something that we're watching closely, but that's what's happening with this consumer confidence, right? They're taking a poll of households across all income levels, and that's what's driving a lower.
So from my perspective as the old guy in the room, the consumer confidence bounces all over the place, but ultimately what matters, what the slide that Billy showed, which was talking about what happened with sales growth, brick and mortar and line, people tend to still spend some way, somehow, even though there's volatility in the confidence thing. And ultimately what we have to watch is what's happening in actual sales and how healthy are the retailers in our shopping centers.
Yeah, and it really, leads us to the next slide. When we're looking at the health of the consumer, is looking at, right, the percentage that they continue to save, right? So consumers saving has gone down a little bit. We were around 5% last year. So far in 2026, 3.5 to 4% range. So, people are being squeezed in various ways. It's something we're watching, and we're watching credit card defaults or things like that. Those have continued to stay actually really steady. Haven't seen a spike in that.
Billy, Dan, thanks for all the effort and putting all this information together to educate our viewing audience here. It's fun doing it. I get fired up seeing the numbers, and it gets me excited about investing more myself. So any other comments, Billy or Dan?
I just say so grateful for those who've entrusted their capital with us. We work hard to protect and grow that every day. We are passionate about what we do. We dig into the macro to the micro. We're eager to share what we do with you. And thank you again for listening today, for your investments with us.